The crude markets have been sending mixed signals since last Monday, with WTI bouncing between technical support and resistance like a drilling pit hitting alternative layers in shale and limestone. I'm Mark Roach, and today we're cutting through the noise on oil's recent movements and what they telegraph for the weeks ahead. WTI started last Monday at 58.45, riding the momentum from OPEC Plus production discipline signals the previous Friday. By Wednesday, we'd climbed to 61.30 on surprisingly tight inventory numbers. The EIA reported a 3.2 million barrel draw when analysts expected a 1.8 million barrel build. That's kind of like a disconnect that makes traders sit up straight. Thursday brought the correction that many technical analysts had been calling for. Prices retreated to 59.80 as manufacturing data out of China showed continued contraction. Their PMIs stuck below 50 for the fourth consecutive month. But the market absorbed this and took another leg down Friday to close at 58.70 as traders squared positions ahead of the weekend. Yesterday's action saw WTI testing support at 58.40 before recovering slightly to close at 58.65. That's essentially flat from where we started last Monday, a week of volatility that ultimately went nowhere. The supply side is where things get interesting. U.S. production has been remarkably resilient despite the Permian's geologic challenges that we've been tracking. Output held steady at 1.31 million barrels daily last week, just 100,000 barrels below the all-time high set in February. What's telling isn't the headline number, but the efficiency metrics underneath. Average new well production per rig in the Permian dropped 3% month over month in April. Operators are now working harder for the same output, drilling more wells to offset steeper decline rates in mature areas. Meanwhile, the Gulf of Mexico is quietly having a moment. Production there hit 1.85 million barrels daily last week, up 7% year over year. The Department of Interior streamlined permitting processes, and it's starting to bear fruit with 3 new deepwater projects coming online since March. While everyone's fixated on supply, demand deserves closer attention. U.S. gasoline consumption hit 9.4 million barrels daily last week, the highest April reading since 2019. The post-pandemic return to normal is complete, at least at the pump. Diesel demand tells a different story. At 3.7 million barrels daily, it's running 5% below the 5-year average. The divergence between gasoline and diesel consumption suggests consumer spending remains strong, while industrial activity is softening, exactly what you'd expect with interest rates where they are. The global picture adds another layer. Chinese apparent demand is down 2% year over year, but India is up 4%. Europe's hold is steady despite economic headwinds. The net effect is global demand growth, about 1.1 million barrels daily in 2025. Not spectacular, but enough to keep markets balanced if OPEC Plus maintains discipline. Geopolitics remains the market's blind spot. The U.S. Ukraine minerals deal signed last Thursday includes provisions for energy cooperation that could eventually bring more Ukrainian gas to Europe. That's bearish for U.S. LNG exports long term, but the timeline stretches well into the 2030s. More immediately, Iran's nuclear negotiations continue making incremental progress. If sanctions ease, still a big if, but we could see 500,000 to 1 million barrels daily of additional Iranian crude hitting markets within 6 months. The market hasn't fully priced this scenario, creating downside risk if headlines turn positive. Connecting these dots reveals a market in equilibrium, but vulnerable to shocks. WTI's trading range of $55 to $65 reflects fundamentals well, but technical factors suggest we're more likely to test the lower bound than the upper in the coming weeks. The spread between WTI and Brent has narrowed to $3.20, the tightest since January. This compression signals that U.S. crude is finding stronger domestic demand rather than flowing to export markets, a subtle but important shift in global oil flows. For producers, the message is clear. Efficiency gains must accelerate to offset both geologic challenges and potential price pressure. The days of drilling your way to growth over the future belongs to operators who can squeeze more barrels from existing assets at lower costs. For investors, the opportunity lies with companies with diversified production portfolios. Those with both shale and offshore exposure are best positioned to navigate the current environment. The pure-play Permian names that dominated 2018 through 2022 are giving way to more balanced operators. Watch three key indicators in the coming weeks. First, the Cushing, Oklahoma inventory levels, currently at 32 million barrels, uncomfortably close to minimal operating requirements. Second, the spread between prompt and 6-month futures, which has flattened considerably. Third, refinery utilization rates as we enter summer driving season. These metrics will tell us more about the market direction than the daily price swings that dominate the headlines. The smart money isn't reacting to every tick, it's positioning for the structural shifts that are reshaping energy markets through year end. WTI's recent movements aren't just noise, they're market processing. They're the market processing complex signals about supply, demand, and global trade flows. Price may have ended where it started, but the underlying dynamics continued evolving beneath the surface. Mark Roach, FutureWise Energy, keeping you ahead of the curve best I can.